What's going on, everybody? Back with another video talking about what I learned from the book Money Master the Game by Tony Robbins and how I'm currently applying it to my investment portfolio. So, for those of you who don't know, this was kind of one of the first books that I read back in 2018, late 2017, and that's what kind of spurred me to start investing or starting to think like an investor. So, this book by Tony Robbins, let me get my pen here. So this is Money Master the Game. It's a pretty thick book, but I'm hoping to kind of summarize the key things that I learned. And this is by Tony Robbins. So Tony Robbins is really big on the educational space. But basically, from this book, what I learned was that there's some bullet points that I learned. So the first bullet point that I learned is that the stock market doesn't make sense. So let me explain how this relates. So a lot of people like to make money from day trading stocks, buy low, sell high. I actually created a YouTube video talking about why I do not like day trading. And it stems from, this book that I read from Tony Robbins, Money Master the Game. And basically the stock market doesn't make sense. It's emotional, it's unpredictable. And let me give you an example. Like Elon Musk, he just bought Twitter, and Elon Musk can send one tweet that offends a lot of people, and that can cause Twitter to crash in terms of their stock price. So it's very volatile, very emotional, it doesn't make sense. So for me, I'm a very logical, systematic person. If I know the stock market doesn't make sense, I'm gonna do something that makes sense for me, right? So basically, I know that I cannot predict the stock market. It just does whatever it does, and you just have to be in it for the long run in order to make money from it, right? So number one, the stock market doesn't make sense. The second bullet point is active fund managers. So it's like 80% of them do worse, so less than the S&P 500. So this statistic blew my mind, right? So active fund managers, they claim that they always say, I can beat the S&P 500, which is kind of the benchmark. And S&P 500 averages around maybe to 7 to 8% long term. So active fund managers, less than 8, only 20% of active fund managers will beat the S&P 500. But if you factor in that active fund managers charge fees, so they have high fees, typically average between 1 to 2%, which is insane. So only 20% will beat the S&P 500, but of that 20%, you're still paying that 1 to 2% fee. So if you factor that in, is it truly beating the S&P 500, right? So why are you paying somebody to actively manage your real estate or to actively manage your stock portfolio when the stock market doesn't make sense? It's purely emotional. The active fund managers get paid a fee regardless of how it performs. Whether you make money, whether you lose money, the active fund managers get their cut and make a percentage. And it just makes no sense to me. Once I learned that concept, it makes no sense to work with an active fund manager. Every time you go to Chase, Wells Fargo, Charles Schwab, they always try to pitch an active fund manager because they get paid their fees. But in reality, if you just invest in the S&P 500, you'll do better majority of the time, right? So now that we know that the S&P 500 is better than most active fund managers, what does that mean? So you want to invest in low cost index funds, right? So what's considered a low cost index fund? So active managers, I just said over here, they charge 1 to 2%, right? If you look at Vanguard, that's who I personally use, or even Fidelity. If you look at their index fund that passively manages the S&P 500, So, Vanguard has their version, Fidelity has their version, or you can do the total stock market, total US stock. The fee is going to be 0.04%. Like, that's insane, right? Like fees compound too. So imagine if your fee is 0.04% versus an active fund manager over here is 1 to 2%. That's a huge disparity, right? In terms of the fee structure. So, and why does the S&P 500 and index funds have low fees? Because they're very passively managed. Like, there's no active person managing it. Vanguard Fidelity doesn't really have customer service. It's very limited, so they have low overhead costs, and it's just a cheap way to get diversification without much fees. So, to kind of summarize, you want to focus on low cost index funds. I personally recommend Vanguard and Fidelity. And, they have their S&P 500 and they have very low fees, right? And then the other concept is dollar cost averaging. So what does that mean? That means that you buy regardless of the price. So you automate it, right? So what I do is I automate, let's say $1,000 a month to Vanguard or Fidelity over here. So if I automate it, I'm buying regardless if stocks increase or decrease, right? So you're dollar cost averaging. Like, for example, when I dollar cost averaged during the bull market back in, a year ago, I was buying my $1,000 maybe bought me fewer shares. But now that the S&P 500 is going down and the stock market's going down, my same $1,000 over here will buy me more shares. But over the long term, it's going to average out, and over the long term, it's going to go up, right? So let me kind of draw this graph here. So let's just say this is the stock market here. It goes up, goes down, and goes up, right? So regardless of the cycle, I'm going to buy right here. I'm going to buy here. I'm going to buy here. So whatever I buy here, it's going to be more expensive versus over here, right? And then when the market goes down, I'm going to buy here. I'm going to buy here. I'm going to buy here. Buy here. So it doesn't matter, right? Whether the market goes up and down, I'm consistently buying. And over time, it's going to kind of average out in the middle, somewhere here, as an example. So, that's why dollar cost averaging is good. It's really just being in the market for a long period of time and consistently buying, and you want to automate that. So kind of the key concept that I took away is it's don't time the market. Don't time market. Instead, it's time in the market. So we cannot predict, when the stock goes up, whether you buy low and try to sell high, that's hard to predict, right? But the only thing you can control is time in the market. So for me, when I put money into an index fund in Vanguard Fidelity, I plan to leave it there for life and never touch it. So never touch. Unless you're closer to retirement age, right? Never touch and let it compound. Let it compound. So basically, from that concept is, don't time the market, increase your time in the market. And when your stock portfolio goes down, like whenever it hits here, like right now, it's hitting home for me. My stock portfolio dipped significantly. Do not sell, because if you look at the data, historical context of the market, regardless of how it does, over the long term, even if it goes up and down, over the long term, it always kind of trends upward, right? Like this is an example. Overall, the trend is going up. So if you stay in the market, you'll ride the wave and always go up. So when you buy during these little dips over here with dollar cost averaging, that is when you make more money, because your $1,000 buys you more, and when it spikes up, it goes up in value. So don't time the market, it's time in the market. And kind of lastly here, slightly running out of space here, but let me share you my index fund portfolio that I personally do. So I have a, let me draw it down here, box that off. I have a 3-fund portfolio. 3-fund portfolio. It's very simple. And I believe I copied it from Ray Dalio, or took a more simplified approach. So I have the total US stock market. So total US. And I have 60% of my portfolio is there. I have the international stock market. So I'm going to do INT for short. That's going to be 30%. And I have the total bond. So it's bond at 10%. And every month I will automate $1,000. So this $1,000 up here gets automated into these 3 buckets every month. On the first of every month, it automates $1,000 a month into these funds, and I continually dollar cost average this portfolio. And I do the total stock market from Vanguard. It's called VTSAX. There's an international Vanguard fund. I forgot the name of that. And there is a total bond market through Vanguard, which is, I think it's VBTLX, something like that. And from there, I just automate this every single month. And these are all low fees, right? Like I think the US, total US is about 0.4%. International is a little higher, 0.08. And I think the bonds is the highest at 0.1. But this is all less than that 1 to 2% over here that active managers charge. So remember, fees compound too, right? So you want to make sure you have low fees. So I know I went through quite a lot here, but let me summarize kind of the 5 bullet points that I go over. So the stock market does not make sense, right? You cannot predict the stock market. So once you understand that, all the power, the controls in your court, right? 80% of active fund managers do worse than the S&P 500 long term, and they have very high fees, 1 to 2%, versus Vanguard, it's going to be 0.04%. You want to focus on low-cost index funds because fees compound too, right? That 1 to 2% fee will compound versus a lower fee of 0.04% will compound less and more in your favor. And I like to use Vanguard and Fidelity, and they have their respective S&P 500 and total US fund. I like to dollar cost average. And by doing that, I automate $1,000 per month, and I'll buy regardless if stocks go up or stocks go down. So look at this graph. Remember, whether it goes up, I'm buying. Whether it goes down, I'm always buying. It averages out. And the last concept is don't time the market, time in the market. Focus on time in the market. So the moment I put money in my index funds, I will not touch it for a very long time. My goal is to not touch it for 20, 30 years and let it compound, do its thing. And my 3-fund portfolio that I use based off Ray Dalio is 60% of the total US stock market, 30% the international stock market, and 10% the total bond market, all through Vanguard, which is what I use. So if you kind of apply this concept of 7-8% growth over the long term, that means your money will double. So double every 10 years using the rule of 72, right? So every 10 years, my money will double. So this is where you see compound interest. The first 10 years, I have 100,000. The second 10 years, it's 200,000. The third, it's 400,000. The fourth, it's 800,000. The fifth, it's 1.6 million, right? The sixth, it's 3.2 million. You can see how it's growing so rapidly the longer you have it. That's why I emphasize time in the market. So overall, I hope you found value from this video. Please like and subscribe and place a comment down below as to what your thoughts are about active fund managers versus low-cost index funds. If you're interested in the Making Multifamily Money course or my direct mailing automation, check out the link down below. And I hope to see you in the next video. Peace.